Yesterday was a sell climax day, and if the bears gapped today down and sold off on the open, it would increase the chances that the market was going to begin a correction. But look what we're doing. We're gapping up. Bear channel, bull flag. We're getting a bull breakout of the bear channel. Theoretically, you had bulls buying above bull bars, and they just use a wide stop, 20 points. And then they scale in lower above the bull bar here or here, and then try to get out break even around these buys up here or here or here. So there are magnets there. I think it's more, it's not the kind of thing individual traders would do, but I do think institutions would do it. And even if they bought here, let's say they buy one tick above that bar, and then they add on above a strong bear bar here, this is their average entry price. It has to get one tick above that line for them to avoid a loss. So some of the institutions who did buy here and bought more here will get out here, break even, a loss here, a profit here, and the two cancel each other out. So on the entire trade, buying here and buying more here, they avoided a loss by scaling in. We're also at the 15-minute moving average, and we're around the midpoint of this final parabolic sell climax. Whenever you have a strong trend day like yesterday, sell climax day like yesterday, 25% chance in the first couple of hours you get follow through selling, and sometimes it can be strong. So sometimes you get a very strong sell-off on the open. Whether or not you do, you only have a 25% chance of the day being a big bear trend day. And right now, by gapping so far up, I think it's less than a 25% chance of a big bear trend day. It would have been better if the bears gapped down and created an island top on the daily chart. I mentioned yesterday that we did not close the gap. Here's the gap above Thursday's high, Friday's low, and then Thursday's high, yesterday's low is now the gap, and the bears could not close the gap. And therefore it's support, and we're bouncing up from there. So, the bears had an opportunity to do something very bearish. They could have had a big gap down today, and then another trend from the open bear trend, and traders would then begin to wonder if we were going to get a 100, 200 point correction. But most reversal attempts fail, and the odds favor higher prices. When the market is in a bull trend, it's constantly trying to reverse, right? But most of the reversals fail. Ultimately, it will reverse, but to bet that any one reversal, that this or this or this is the start of the correction down to support, is a low probability bet. Anyway, what I was saying is, when you have a strong trend day like yesterday, bear trend day like yesterday, you have a 25% chance that today will be a strong trend day. And by gapping up like this, it's less than 25% chance that today will be a strong trend day. And you have a 75% chance that you'll have at least 2 hours of sideways to up trading beginning by the end of the second hour. You know how yesterday opened on its high tick and it remained the high of the day? Look at bar one. It's opening on its low tick, and the bulls want the low to remain, the open to remain the low of the day. Not likely. As I said, you only get about one bar a year where, like yesterday, where it opens on exactly on the high tick, and that remains the high for the rest of the day. And now the bulls are trying to do the opposite. It opened on the low tick, and they're hoping today will have the open as the low of the day all day. The market often does symmetrical things or opposite things. So a lot of times it'll do something today that it did yesterday, or it'll do the opposite of what it did yesterday. What are the odds that the open is going to remain the low of the day? I would say small, maybe 10% or so. However, if we start to get a series of strong bull bars, instead of 10%, it becomes 20%, 30%, 50%. And yesterday, somewhere in here, over here, it was 90% chance. Once you get below that 18 low, 90% chance this is going to remain the high of the day. So what do you do here? We broke above the bear channel, bull flag, and we broke above the 60-minute moving average, and we opened on the low of the day. But the odds are we're going to trade below the open, trade below the low, because that's what happens, 90% of the time, or maybe 80% of the time, when a day opens on the low. So right now the odds are we're going lower. I think we're always in long just from that one bar breaking far above both the bear channel and the 60-minute moving average. But, think about it. Big down, big up, and you know what I'm going to say next, big confusion, and that makes the trading range likely. And trading ranges in general, better to buy low, not buy high. And this is already different from yesterday. Yesterday we sold off on that first bar and did not rally on the second bar. Here we sold off, we rallied on the first bar, and we've already pulled back a lot on the second bar. So this is consistent with what I'm saying, that there's probably an 80% chance we're going to trade below the low of 1. The first bar of the day always has a 20% chance of being either the high or low of the day. Let's say the low of the day comes early in the day and we stay above yesterday's low. Well, right now we're probably going to stay above yesterday's low because of two things. First of all, we're opening fairly high above it. And second, yesterday at the end of the day, when the volume is huge, even with all that volume, the bears were unable to get below Thursday's high, the gap. They were unable to close the gap. And therefore, we know the buyers down here are strong. If we sell off, they'll probably be strong again, and that makes it unlikely that we're going to get below yesterday's low. Yesterday's high is, I think, pretty far up, given the sizes of the days lately, and that means we're probably not going above yesterday's high. Just like yesterday went above the day before's high and reversed down, and then below the day before's low and well, it stopped. But anyway, it was an outside down day. Today looks like it's probably going to be an inside day. Who's going to sell below 2? Let's say 2 closes on its low. Well, there's room to the 5-minute moving average, but you have to get through the 60-minute moving average first. So this is a confusing open. We already have big down, big up, trading range likely. And on the first bar, we're up, and the second bar, we're down with support not far below. 50% chance we'll get some follow-through selling, and sometimes it's dramatic. Sometimes you just get, 3, 4, 5 big bear bars going down to support, like yesterday's low, and then reversing up sharply. So nobody's going to sell on the stop below 1, but you can see what I said, how 1 was the low of the day, open of the day, low of the day, but we've already dipped below it. So it's not, the open of the day is no longer the low of the day. Buyers or sellers here? For the bulls, it's a gap up and a pullback. They're hoping for an early low of the day and a reversal up. This is a small version of something that we see fairly often. Gap up, pullback, low of the day, we reverse up. Gap up, sell off strongly, but it's still a pullback, forming an early low of the day. Gap up, pullback, and then it became a bull flag. So bull trend, wedge, bull flag, low of the day. Gap up, pullback, reversed up. Gap up, pullback, reversed up. Very common pattern. Well, on the open, you very often get strong moves up and down. We have a gap up and then a bull bar, and then we have a reversal down. And in general, no matter how strong a move is on the open, 50% chance it's going to reverse. Bears want to get down to the moving average to yesterday's close, and they really want to break below yesterday's low because yesterday's low was important. It held above the high of 2 days ago, or Thursday's high, and it kept the gap open. Can today still be a big bear trend day? Yeah, in general, 25% chance the day after a sell climax day is also a big bear trend day. 25% chance, that's not very high. Everyone knows that with this big gap up, the odds favored an inside day. And everybody knows by the market not gapping strongly below yesterday's low, the bears reduced the chances that they would be able to have a big bear trend day today. Will bulls buy at the moving average? They might. I did not. Will bears sell closes here? Look what happened at this price at a major support level yesterday. Reversed up, sold off, and then we gapped up. So it's more likely that there are buyers somewhere here than this is the start of a big bear trend. Confusion, big down, big up, big down, right? Confusion. This is probably the start of a trading range. Bears trying to create a bear trend day. We've already overlapped a lot of yesterday, right? You can see on the daily chart, we're overlapping a lot of yesterday. And that reduces the chances that today will be a big bear trend day. However, if we break strongly below yesterday's low, even though we gapped pretty far above yesterday's low, today could end up as a bear trend day. I think it's much more likely that today is going to either be an inside day and stay within yesterday's range, or if it drops below yesterday's low, that there'll probably be buyers not far below and will still end up overlapping a lot of yesterday's range. Because the weekly and monthly charts are so historically overbought, there's an increased risk of a big surprise to the downside, a big trend down lasting many days, starting at any time. But the odds are looking at any one day and saying, well, this is probably going to be the start of that. No, it's probably not. The odds are every day is, the odds are against any day being the start of a big bear trend, especially when the market's in a strong bull trend, even though eventually one day will be the start of a bear trend. So right now it's more likely this is a sell vacuum test of yesterday's low and that we're going to get an opening reversal up. In other words, we sell off, maybe for 5 bars, maybe for an hour or two, but the odds are we're going to reverse up from somewhere around yesterday's low, either a little bit above or a little bit below. Now, for the bulls right now, this is an opening reversal up. So if 5 is a bull inside bar, then we have a high 2 buy. We have a gap up, so a bull trend breaking above yesterday's bear trend. So a bull trend and then bull flag. And it's a high 2, high 1, high 2. But with the 3 bear bars closing near their lows and 2 of the bear bars being fairly big, it's similar to yesterday, 2 big bear bars early on. Chances are bears will sell the first rally. 2 big bear bars early on. Chances are the bears will sell the first rally. So while the odds are against a big bear trend day, the sell-off is strong enough so that the bulls will probably need some kind of a double bottom before they get their opening reversal. 2 big bear bars, the bulls needed a double bottom. Here we got consecutive sell climaxes and a very sharp reversal up. The bulls had a micro double bottom. Strong sell-off, bulls needed a double bottom. Strong sell-off, the bulls reversed up, but bull leg in a trading range did not go straight up. Strong sell-off, bulls needed a double bottom. Strong sell-off. Now here we got bull, bear. So we did not have consecutive bear bars. Today we have consecutive bear bars. Even then, with the reversal up, there was a deep pullback. So a type of a double bottom. Strong bear bars, consecutive bear bars. The bulls needed a double bottom. Who's going to buy above 4? I would not. Yesterday the bull scalpers who bought above 3 made a 1-point scalp, but the bears still sold the 3 high and higher and made money. And similarly today, the bears will sell the 4 high and at least scalp. Most bears believe that because we gapped up and opened so far above yesterday's low, today is not going to be a bear trend day, and therefore the bears will mostly scalp. Bears got their input 1-minute chart. Did that? No, they did not. I was wondering if the bears, see, they sold here and they need 5-tick drop. The reason I had to do this is because my data on my other computer is not the same as the data on this computer. Sometimes TradeStation messes up and one of my platforms locks up, and so I look at the chart and I look at this computer, and the bars look different. So I have to quickly figure out which one is locked up, and if it's this one, I end up having to reboot this computer. If it's the other one, I restart TradeStation or reboot the other computer. All right, so for the bears, it's a low 1 short. We have a strong bear reversal and a pullback, so a bear flag. And for the bulls, as I said, they're hoping for an opening reversal. The odds are we're going to have an inside day, and since we're near the low of yesterday, the odds are we're going to reverse up at some point in the first hour or so. So far, not a good buy, other than it's a high 2, high 1, high 2, and a pullback to test the top of the bear channel. The bulls probably will need a major trend reversal. On the open, sometimes patterns are small. Sometimes on the open you'll get a major trend reversal where you just go up for a couple bars and down for a few bars, and that's it. And it just becomes a bull trend. Usually not. Usually you need more bars for a major reversal. And if you're getting a reversal with only a few bars, the reversal is usually minor. And it can grow into a major reversal. But when you're only up for 1 bar here and only down for 2 bars here, that's usually too small to lead to a major trend. Usually you need more bars. We had that over here. Okay, fairly tight channel. First reversal up usually minor. Bulls usually need a double bottom. Here, very tight bear channel. Usually the first reversal up is minor. You usually need some kind of a double bottom. Here, a lower low. So a lower low, major trend reversal. Same thing, very strong sell-off. Usually you need some kind of a double bottom before you can get a reversal. Low 1 short below 5, but a bull bar, and we're in the buy zone around yesterday's low. Right now the odds, even though we're selling off on the open, the odds are against a big bear trend day because we did not gap down, so we did not get immediate strong selling, and we could have, and in addition we gapped far above the top of the bear channel and in the middle third of yesterday's range. So the odds are that we've already overlapped yesterday's range for all the bars so far today. that increases the chances that today will be either an inside day or not fall far below yesterday's low. What happens if we just collapse below yesterday's low? Well, then the market will have changed, and then we could end up with a big bear trend day. Yesterday was an outside day, and last week is not all that big. We traded above its high, and therefore this week could become an outside down week and get below last week's low. That's last week's low. I'm going to highlight that just in case we start to get near it at some point this week. A little bit of a parabolic wedge. We reversed up, and if we reverse up a third time, it could be a parabolic wedge low of the day, testing yesterday's close, testing yesterday's low, and testing that gap on the daily chart. Let me put a line here to show the gap. The gap, we closed the gap if you use this high, but if you use this high where we gapped up, we did not close the gap. So to me, the gap is still open. For the bulls, they need a bull bar. And if they get it, because it's a possible low of the day, it's an okay swing buy, but also because this channel is tight, the first reversal up probably will be minor and we'll probably have to go sideways here. So a reasonable swing buy. But a lot of traders will end up scalping out with 1 or 2 points and then wait for a double bottom before they swing trade. Kind of like this. A lot of traders will scalp the first reversal up and then wait for some kind of a double bottom. Here, a lower low, double bottom. You can call it a wedge bottom, lower low, major trend reversal. That's when they swing trade. Same here. First sell off tight. So a lot of traders only scalp initially, and then they're more willing to swing trade on a second entry. Does this bar have to close on its high to make bulls buy? No, it's already a parabolic wedge, and we're in the support zone. Sometimes it'll close down with just a one-tick bull body, but I think the minimum that the bulls want to see is a bull body. The bar already has a problem, and that is it's relatively big, which means the bulls have a wider stop, so they have to risk more than what they want to risk. And that increases the chances of a trading range as well. Whenever something doesn't look right, whenever the buy signal bar just looks too big or if it has too big a tail on the top, yet the context is good, you got to be thinking that there's an increased risk of a trading range. Whenever things don't look right, it usually means there's a lot of trading range price action. It means the opposite forces are reasonably strong. Limit order bulls buying below 5 made money, which makes sense. A bull bar at support. So bulls either buy the 5 low and 1 point lower, or they start buying 1 point lower. It has to get 1 tick above the 5 low for them to make money, which it did. Stop order bears below 4 or 5 did not make money and had to fall 6 ticks. So here we are in a bear trend. The bears did not make money. The bulls did make money. So that further increases the chances that we're going to form an early low of the day. Not necessarily right here. We could go a little bit lower. We could go sideways more. But It's still consistent with what I've been saying, that today might be an inside day, and which means it does not fall below yesterday's low. Since we're testing yesterday's low, if it does not fall below yesterday's low, we probably would then have to rally. So the odds right now favor an opening reversal up at some point soon. Probably a minor reversal in a trading range. If you want higher probability, you wait until we get a strong reversal up and it's clearly always in long. And at that point, the stop is further away, but the probability of making money is greater. This kind of situation, we have the two big bear bars. There's always an increased risk of a third push down. 1 pullback, 2 pullback, 3. Bears want a double top 5. Bulls want a parabolic wedge, higher low, major trend reversal, early low of the day. While I think we're going to get an early low of the day, the probability is not yet high. I think it's 50-50 chance that we're going to bounce here, 50-50 chance we'll get one more push down and then bounce. For the bears, a double top bear flag, but 2 bull bars at support. Plus the bears had a 5-tick trap below 5, so confusing open. 6 bar tight trading range. Everybody wants clarity, but reversed up, reversed down, reversed up, reversed down, pretty prominent tails. To me, the probabilities are not all that high for bulls or bears. I would not sell above 8, and I probably will not sell below 9, because I still think an opening reversal up and an early low of the day is more likely than this being the start of a bear trend. For the bears, double top bear flag, and the bulls have a 5-tick trap, but probably not much downside. We're in a tight trading range, and stop order bears and stop order bulls each have a 5-tick trap. Still always in short, but a terrible location for the bears. The bears don't want to see the market collapsing and stalling at support, so a lot of bears will not sell here, and the bulls did not like this big bear bar with only one more leg down, so a lot of the bulls did not buy here. So a lot of traders are waiting for more information. Bulls still on their buy, hoping that this will be the low of the day. A lot of times when you get a reversal day, and that's what the bulls want, the reversal is an endless pullback, a bull channel that keeps looking like it's going to reverse down, yet it continues to go higher. This is a pretty strong reversal day, and if we get this, it makes it easier to buy and hold. But a lot of times you do this, and it's not all that clear. Or this, well, this is pretty good, but even then, with these strong reversals down, it's fairly hard to hold. It makes it easier if you get that. And this is what the market's deciding right here. Is the second leg down enough, or do we have to get one more leg down before we get the reversal? So right now we're at this point, and the bulls are hoping this is all they need, and the bears would like to get run the stops on the bulls, and then the bulls need a third reversal up. So right now we're at here, which might be enough, and we just don't know. The market is trying to figure it out. Oh, we always didn't long yet. Well, we have a 7-bar bull micro channel, but the bulls only have a 5-tick trap. The location is great for the bulls, but they do not yet have a strong bottom. As I said, the reversal is probably minor, which means the bulls will probably need some kind of a double bottom. The bears see this as a wedge bear flag. 1, pullback, 2, pullback, 3, and they want a new low. No matter what happens, it looks like we're going to have a fairly quiet day. I said I thought today would be either an inside day, or if it fell below yesterday's low, not fall far below yesterday's low. Nobody's making money. The range is really small, and no movement. Stop order bears did not make money below 5. Stop order bulls have not yet made money above 7. And limit order bears have not made money selling above 7. And limit order bulls have not made money buying below 13. So over the past 8 bars, 9 bars, nobody's really making any money. As you know, I'm more bullish than bearish, but it's hard to be very bullish when the bars are small. Again, this is a bear flag. We have a sell-off and a wedge bear flag, and the bulls are trying to get a bull break above the wedge bear flag and then a measured move up to a new high of the day. Location, good for the bulls. So I would either be long or flat. Probability might be a little bit better for the bears until we get the bull breakout, but I'd still rather be long than flat because I think the math is better. Probability, right now it's not, but at this point the probability of testing down was greater than the probability of reversing up. But whether or not we tested down, the probability was we were going to reverse up. From the open, I said I thought we would get an opening reversal up from around yesterday's low, because today was likely to be an inside day. Yesterday's a huge bear day, and we opened in the middle third of its range, and that usually leads to an inside day. For the bears, it's a wedge bear flag, but probably buyers not far below. And for the bulls, it's a small pullback bull trend, but mostly sideways. So not good trading because the range is so tight. Is it a stop entry scalp? No, just like buying above 14, the math is not good enough for a scalp. Selling below 15, math not good enough for a scalp down. You can sell for a swing, but there's probably going to be buyers not far below, so not a great swing. And for the bulls, can they hold long, stop below 7? You can see we went 6 ticks above 7 and sold off. And that tells me that a lot of the bulls decided that the market's so quiet, it's better just to scalp out with 1 point. So a lot of the bulls are flat. Bulls again trying to get their break above the bear flag and then the measured move up to the high of the day. Will the bears sell above 16? I think it's too low in the range. They're hoping that we're continuing to channel down. We have a lower high compared to that high. So maybe on a 15-minute chart, we're starting to get a series of potentially lower highs. But to me, I think this looks like a bull trend, a bull flag, a bull breakout, and a pullback. That's the 15-minute chart. Here's the 5-minute chart. Someone asked about tick divergences yesterday. I know it's a messy chart, but it makes the point. I put up a 1-minute E-mini chart, a 1-minute tick chart, and a 1-minute volume chart. And what I'm looking for is ticks falling below 1,000, minus 1,000, which they did here. So you get a strong bear trend, and it's so strong the ticks fell below minus 1,000. And then on the 1-minute chart, I'm looking for 2 more pushes down, and I want to see the tick low be higher and then higher. So I want to get lower low in price, higher low in ticks, and lower high in volume. So at this low, here are the ticks, here's the volume. We have a lower low in the E-mini, slightly higher low in ticks and lower volume, and then another slightly lower low in price and a slightly higher low in ticks, and again lower low in volume. So there's a divergence and a double divergence, a divergence and a double divergence. I'm going to go back to the chart right now. Okay, so always in long, and in general, you see a strong breakout with good context, you'd say 60% chance that it's going to be successful and that we're going to go up. But when we have so much quiet trading here, there's I would say, it's more like a 55% chance the breakout will succeed, and 45% chance it's a second leg trap. First leg up is a wedge, and then the second leg up is this bull breakout. So it's less bullish than it otherwise would be. So on tick, so E-mini is falling strongly in a sell climax. Wedge bottom, 3 pushes down, and there's a double tick divergence and a double volume divergence. So ticks, you got 3,000 or so stocks on the New York Stock Exchange, and if one stock goes up compared to its last trade, it creates a +1 tick. If another stock goes down, it creates a -1 tick. You add all that up and you get ticks varying between -3,000 and +3,000. It never gets to 3,000 or up or down, but sometimes it gets to -1,000 or +1,000. And if it gets to -1,000, that requires very strong selling. It means most stocks are going down. But it can be climactic, and that's what I'm saying. If there's a good reason to look to buy, let's say the 5-minute chart is at major support, and then I see ticks hitting -1,000, and then lower prices in the E-mini 2 more times, and the ticks going up and the volume going down, it makes me think the volume is drying up. As the market's going lower, fewer stocks are going down, and fewer total volume is going, fewer stock, and there's less volume. So as the market's going down, there is less trading, and the purpose of the market is to increase trading, and therefore the market's going the wrong way. If it's going down and the trading is drying up, it probably is going to run out of sellers pretty soon, and it has to go higher to find sellers, so bulls buy reversals up. Second leg trap, we have an attempt at a parabolic wedge top and got a bull breakout, but the bull breakout was a trap. Common situation, we have the first leg up is a wedge, second leg up is a breakout, and it fails. Here, a bigger wedge, and the second leg up, a breakout. Here, 2 legs up, 1 pullback, 2, and a trading range. Sometimes it can be very big. 1, pull back into a trading range, and then 2, the breakout failed. Sometimes it can be dramatic. 1, pullback, 2. Here, tried to get a bottom, and instead we broke strongly to the downside, and it was a trap, and we reversed up. Will traders sell below 18? Well, I think a lot of the bulls will get out below 18 if it closes on its low, or if it has a 1-tick bear body, 1-tick tail below. If it closes on its high, then it's confirmation that the breakout is good, and a lot of traders will buy the close. Whenever there's a possibility of a trap like this, and then you get the follow-through bar 18 closing on its low, I never buy that low. On the other hand, if it's maybe a 3-tick tail with a 1-tick bear body, I might buy that low and take a chance that we're channeling up. Sometimes, if the context is right, I'll sell on a stop below 17. 18, excuse me. And to me, this is not the kind of thing that would make me do that. Okay, so terrible follow through. You can buy right here at the market and put a stop 1 tick below 18, right? Or 2 ticks below, arguing that the bulls do not want the market to fall below 18, and therefore they'll buy here. And if they're successful and keep the chart from falling below 18, then we could get a measured move up. It's one of those low risk trades, and that always means low probability. In other words, it means if you buy right here, you're probably going to get stopped out if you use a tight stop, 1 tick below 18. But the math is still okay. Even if you lose 80% of the time, you're only losing 2 ticks, and you're trying to make 3 or 4 points up, and so that reward more than offsets the low probability. Caterpillar. There are all these cliches that you hear about different stocks, and a popular one with Caterpillar is, I remember when the market was like right over here somewhere on Fast Money, one of the guys said, oh yeah, the price is justified if you believe Caterpillar is going to dig every hole on the planet. Caterpillar makes construction equipment. And, to me, it sounds good. A lot of things sound good, but they're stupid. And, that's one of those sound good, stupid things. If the market's going up, I don't care if Caterpillar has to dig every hole on the planet to justify its price. If it's going up, it's probably going to continue higher. So for me to say, oh, I don't want to buy because they have to dig every hole on the planet to justify this price, well, who cares? If it's going up, it's probably going higher. Now it's obviously in a parabolic buy climax, but back over here when they were saying you can't buy it because it's way overpriced, markets, you can say the same about the E-mini, right? Just because something's overpriced does not mean it has to go down. It can continue to get further overpriced, and that's what's going on with the E-mini now. Even though it's a negative gap, 1 tick overlap, 15 high, it's still a possible measuring gap. Takes us above the high of the day. Are we always in long? We probably are, right? If it falls below 18, I might change my mind, but right now I think it's more likely to go up than to go down. I've been saying that since the open of the day. Now you got buy the closed bulls 1, and they bought more above a bull bar 7 or 8, and they probably will be able to make money. So we probably have to get up to that 1 close, and once we get there, you might get some selling because the bulls who bought the 1 close hoping for the low of the day, confident that we would not fall below yesterday's low or much below yesterday's low. They bought more above a bull bar, 7 or 8, and now they're disappointed by this sell-off, and they're concerned that instead of a bull trend, it might be a trading range. They'll be happy to get out break even at their first entry, and then with a profit on their lower entry. So there should be some sellers around the 1 close. Sometimes those bulls will place the limit order a tick or 2 below the 1 close, so sometimes it does not get above the 1 close. Who's going to sell below 20? Well, the bulls who bought that 18 close or 1 tick above made money, and you have some limit order bearers who sold the 15 high and sold more higher, betting that today is probably going to be a trading range day. I think they will make money. I don't know if they'll make money in the next few bars, but I think they'll make money. I've been saying since the open, inside day, trading range day, and I said, if we get an early sell-off, we'll probably get an early low of the day and a reversal up. the reversal up is weak. So will this be a reversal into a big bull trend like we had last week? A sell-off, opening reversal, and then a big bull trend? Probably not. The reversal up today is not strong like this. So today is probably going to be your regular garden variety reversal day that ends up as mostly a trading range day. Who's going to sell on a stop below 20? To me, it's a limit order market for sales. We're always in long, and here we get a fairly tight channel. Some bears sold either the 15 high and 1 point higher, or they sell 1 point higher, 2 points higher, which is better because the odds are we're going to get closer to the close of bar 1. So probably buyers below 20, even if it closes on its low tick, probably the best the bears get is sideways for a few bars. The odds still are that we have to get closer to the close of bar 1. How close? Well, usually within a tick. Here we're 2 ticks away, and that's probably not close enough. Remember, legs in trading range days usually last 2 to 3 hours. Sometimes the first leg is brief, an hour or less, but after that, usually you get a 2 to 3 hour leg. And this has been going up for about an hour and a half, and therefore we'll probably go more sideways to up. Can we go much above the open? Of course, right? But we probably will not end up in a big bull trend day. Sometimes when you're going to get a trading range day, the market trades down, and then it goes up for a measured move based upon the distance from the open to the low. And then later in the day, it comes back to the open, and the day becomes a doji day. You can see on the daily chart, we have a lot of days that are closing around their open. And a lot of times the open is almost exactly in the middle of the day. And the market goes down, it goes up, and then closes back around the open. Here's an example of one of those days. Another example of it opening and closing around the middle of the day. Always in long, not strongly bullish. Scale and bears, I believe the odds are probably 70% they'll make money, but they may have to hold for several hours, and they may have to put a stop, somewhere above here. So it's not so easy, not so obvious. Bulls trying to get a breakout test, a gap, it looks like the 21 low and 15 high. But trading range days tend to disappoint bulls and bears, and this rally is not very good. A lot of bulls want to buy a pullback. They don't care if we get a pullback, as long as it goes sideways and stays above the moving average. They don't want to buy a quick sell-off down to below the 16 low. The reason we're not going up is the bulls don't want to buy high. They want to buy pullbacks. They can see the rally is not strong. And when a rally is not strong, bulls prefer to buy pullbacks instead of new highs. Everyone knows the odds are we're going higher, but no one's certain if we're going straight up or if we pull back first. The bears are hoping that this is a bull channel bear flag and that we break to the downside, but even if we do, right now I think the odds are we've seen the low of the day. We're already bar 24, a couple hours into the day, so that's after bar 18, and by the time bar 18 forms, 90% chance either this stays the low of the day or this stays the high of the day. Because I think since the open, I said I thought we were going to get an opening reversal up from just above yesterday's low, I think the odds are this will be the low of the day. So I think we're not going to get down here again. And I don't know if we get a new high. The day's range is already about 6 points, and that's big enough. It might be as big as we get. I think we're going to go higher because I think we have to get to within at least one tick of the close of bar 1, so that by the close bulls who bought the 1 close can avoid a loss or only get a 2-tick loss. Usually it has to get to within 1 tick. This is usually not enough. This is 2 ticks. What happens if we sell off? Well, I think the best the bears will get is a leg in a trading range, support around the 16 low. But in a trading range, the market often goes above resistance and then turns down, and then below support and then turns up. While I think there's a 90% chance we've seen either the high or low of the day, and right now maybe a 70% chance we've seen the low, we could easily fall below 16, but not below 6. So probably buyers below 16. The bears are hoping this is a strong bear breakout, and this is a pullback from that breakout, and a bear flag. So bear trend, bull channel, bear flag, and they want trend resumption down. They want to sell the close bears 6 to be able to avoid a loss. Those bears will sell more below a bear bar, maybe below 15, probably not. You want to be at least 2 or 3 points above your first sell. They might sell more below 21, trying to get down here. And as I said, by the close bulls 1 probably bought more here, and their average entry price is well above their average entry price. If it does not get to the 1 close soon, a lot of the bulls who bought that 1 close and more down here will just get out, break even on the trade. All right, so to sell, I think it's not a strong sell. The channel is tight. You can argue wedge 1, 2, 3, but it's a small pullback. Bull trend. We had a 1 bar pullback, a 1 bar pullback, a 1 bar pullback, and so the pullbacks are small. Then they're falling. Well, we fell 3 ticks here, we fell 2 ticks here, and the pullbacks are only lasting 1 bar, and therefore this sell-off is probably a minor reversal, and the best the bears probably will get is a trading range, maybe down to the 26 low, maybe the moving average. The bulls, I think, probably will wait several bars before they buy again. You can see that there was selling at the 1 high. Both bulls and bears sold there. The bulls sold there to take profits on buying the close and buying more lower. The bears sold there hoping for a scalp, and those bears right now have a 4-tick trap. It has to fall 1 more tick for them to get filled. And some of those bears are buying back their shorts right now because it hit their limit order, did not fill them. They were scalping, and they don't want to give back their profit. We still have room to measure move targets above. I think we're still always in long. I still think it's a bull leg and what will become a trading range day. I said that legs in a trading range day typically are 2 to 3 hours, and we've been 2 hours up, so we've met that minimum. We've hit the target, the open of the day, so we've met that minimum. But I still think we're probably going to go a little bit higher, although this is some overlap, 18 low and 15 high. The bulls were able to prevent the market from falling below that bear bar, 18. If it fell below 18, it would have changed the character of the day and made it likely to enter a trading range at that point. Because it did not fall below 18, and then we tested the 18 high again, 25. We tested the 15 high again on 25. That tells me the market thinks the 15 high is important, and therefore it probably will result in a measured move up, and this would be a logical bottom. So measured move up from here to here, up there. So I think the odds are we're going higher, although we might go sideways for a few bars before we go higher. So now we have a 2-bar pullback. Here we pull back 1 bar, new high, pull back 1 bar, pull back 1 bar, new high. Now we're pulling back 2 bars. We're still always in long, and we're probably going to go sideways here, maybe in this tight range. And the market should not fall below that 25 low, because that's the second test of the 15 high. And if you're getting 2 tests, usually the market goes up, and therefore this breakout is probably this is probably a pullback from this breakout and not a reversal. So the odds are slightly better that there are buyers below and that we're going at least a little higher. But as I said, I think today's going to remain a trading range day. It's going to remain an inside day. We still have not broken beyond the 18-bar range. So still 90% chance we've seen either the low of the day or the high of the day. I think it's slightly more likely that we've seen the low of the day, because I thought today would be an inside day, which means we test yesterday's low and reverse up, or test yesterday's high and reverse down, or both. And we reversed up from yesterday's low, so chances are we're not going to get below yesterday's low. Can you buy here? Arguing we're still always in long. I think we're always in long. I think it's a small pullback bull trend, but I think it's a small pullback bull trend in a trading range day. We hit the minimum target, the close of 1. Right now I think we'll probably go higher, but if we fall below the 25 low, then we may have seen the high of the day. We tested the 15 high on 18, and then we tested it again on 25. And if we drop below 25, then to me the test failed, and then we'll probably try to get down to the 16 low, maybe even the low of the day. So that 25 low is important. As long as we stay above it, I think the odds are we're going to go a little bit higher, but not much higher. Remember, I said the day may end up, first of all, I said it would probably be an inside day. And second, I said it may be a doji day closing around the open. What happens if we sell off at the end of the day and close near the low of the day, but it's still an inside day? Then it would be a bear inside day in a very overbought market. Unless the bears get a strong reversal down, the odds are we'll continue to go higher, 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 at least a little bit higher. As you know, I don't think we can go much higher over the next few weeks, because the market has never been this overbought. I saw one measure yesterday. Let me see if I have it. There was a chart that I saw, but it's basically what I've been talking about. This, okay, 1928. So, 90 years. Okay. This is how many days the market has gone without a 3% correction. Here, the market went 241 days without a 3% correction. And now we've gone more. So this is the most days, since this 3% correction, this is the most days that the market has ever gone without a 3% correction. These corrections are not 3%. These are like, 30, 40% corrections. All right. This is a log scale chart. And, but right here, there was actually a tiny 3% correction. 3% correction, you're not going to notice on a monthly chart that goes back 100 years, but there was a 3% correction here. I should add some text to this. I'll fix this on the other computer. Anyway, so this is more likely a bull flag, probably not going a lot higher. The limit order bears who sold the 20 high did not make money. The limit order bears who sold the 1 close did make money. So difficult to make money doing much of anything. However, it's still slightly more likely to go a little bit higher before we get a bear leg. But this is a bull leg and a trading range day, and we're probably not going a lot higher. Sometimes when you get reversal days like this, after the reversal, it just keeps trending up all day. But usually you do not get a big bull trend day out of it, especially when the reversal up is as weak as this is. All right, this is a pullback down to around the moving average. You can call it a triangle. I still think we're always in long. I still think the odds favor higher.
Muted.
Nobody's interested in trading. The market is just, staying in a very tight range. We've been in a 2-point range now for about an hour and a half. I want to go back to that 3% correction slide. Okay, I added some text to it. This is a log scale monthly chart. It's 90 years. This is a 90% correction. 1987 over here was a 26% correction. So a 26% correction is barely visible, and a 3% correction is not visible at all. But inside this red box right here, there was in fact a 3% correction, and it was the first one in 241 days, and the height of this bar is the number of days, and that is the longest that the market had ever gone without a 3% correction since the since before the 1929 crash. So in 90 years, that was the longest stretch right here. Here's where the stretch began. This is 241 days from this 3% correction to that 3% correction. And now, as of Monday, we were even longer without a 3% correction. And how much longer can we continue? Well, there's no rule, right? But it's consistent with what I've been talking about on the weekly chart and the monthly chart, that we've gone an incredible number of days without touching the average price. So it's just another way of measuring how overbought the current market is. Look at that, I. So 4 consecutive inside bars. But, it's really not a very good setup because the range is so small. The past 15 bars, 20 bars, really tight range. Still always in long, still more likely to go higher. But anyone buying up here, stop has to be at least 1 tick below 25, which is the second test of the 15 high. Testing the 1 close again. So we have a double bottom, 18 low, 25 low, and now a double top here, testing the 1 close. So a lot of the bulls will get out here. As far as bears shorting, it's more limit order shorts, and I don't think it's good to be shorting this low. Will we fall below the 25 low? I think we will. I think we'll probably get down. I don't know if we'll get down to the 16 low, but we might. We've been in a very tight range for 2 hours. The day will probably stay a mostly small day. What do you do here? Well, I think you get out of longs, and depending on how the sell-off looks, traders will look to buy. I don't know. I think they're going to wait to see if we fall below the 18 low and the 25 low. If we start to stabilize here, they'll buy at the bottom of the 2 hour range. If we break strongly below, then they'll look to buy around the 16 low. Bottom of the range. Can you sell on a stop here? I would not. You're at the bottom of a tight trading range. Bad place to sell for any reason. You're at the 60-minute moving average, and it's a tight trading range and a trading range day. And in general, this is a buy zone. What about buying at the market, betting on the double bottom? The market should not have done this. It should not have come down to the 25 low. Makes me think we're going to go below the 25 low. And therefore, probably sellers above 45. We'll probably get a second leg down. You can say it's already 2 legs down, one pullback 2. But I think 3 consecutive bear bars and all the way down to the 25 low, we're probably going at least a little lower. The bears would like a measured move down. We have a tight trading range to the 16 low. That's the target on the downside. But we have the 60-minute moving average, which is pretty reliable support. And that makes it harder to get down there. Right now, I would do nothing. You could be on a swing short. You could sell above 45, 44, 43. Taking a chance that we're going lower. Some bulls are buying with limit orders, 1 tick above the 25 low. I think they will not make money, so I think, so they get filled at 25.67 even. It has to go to 8 1/4 for them to make money. And I think they'll be lucky to make money, and that means there'll be sellers around 68 even or 1 tick below, and the bears will sell there. Breakout mode, 41 high, 45 low. I think slightly more likely that we'll break below the 45 low, but I think we're not going to go very far one way or the other. Just a very quiet day. We still have measured move targets above, but if we get below 25, this measured move target, then I think is no longer significant. You can see that even though it's a double bottom 25, there's hesitation, and I think there's a 50-50 chance we're going to fall below the 25 low before we get above the 41 high. We're in the middle of a 20-bar tight trading range, breakout mode. Good reason to go down, and we have a double top at the 1 close, and good reason to go up. We have another test of the 15 close, which I think weakens the bull case. Can you buy on a stop, betting that we'll quickly go up for a measured move? I think if you're buying, you want to be buying near the bottom. If you're looking to sell, this is the sell zone near the top or above the top. If you're worried about a big breakout, instead of selling at the high, you place a limit order to start selling 1 or 2 points above. Reversal day. If it sells off a lot on the open, usually you don't get a big bull trend out of it, even though you could trend up all day. Usually do not get too far above the high. This is a pretty good reversal day for the bulls, and the same with here, but we still ended up closing back at the high. This is more typical. Very strong sell-off, reversal. We trended up all day, but never got above the high. When you get a reversal day, you can trend up all day, but usually it does not get far above the high of the day. Another reversal day, could not get above the high. Strong sell-off, reversed up, barely got above the high. Strong sell-off, reversed up most of the day, never got above the high. Reversed up, mostly sideways. Reversed up strongly, but never got above the high. Here, if you have a small sell-off initially, you can get a very big reversal. But most times, if you get a fairly strong sell-off, even if you reverse up for the remainder of the day, you do not get above the high, or if you do get above the high, you only get a little bit above the high. Therefore, this is probably not going to break into a strong bull trend. Still holding above the moving average and still always in long, and still room up. A lot of times when you get these reversal days, like I said, they just keep going up all day long. They don't necessarily go up far, but they just tend to keep going up all day long. Sometimes they stall and go sideways. You know, here we went up for first 3.5 hours and then sideways. That does not look like today. Today looks more like one of those days that just kind of keeps working higher. You know, kind of like this. Here we got to break out that trapped, the limit order bears selling above. Today has much less energy than this day. This sell-off is bigger than today's, and the bull bars are bigger than today's. Bulls got to break out 50, and they have an III pullback 56, a small triangle. We're always in long. We still have targets above. So if you have to do anything, I think it's better to buy. You know, I showed that example of a weak rally like this and then a sudden breakout. Well, one thing that's different is this is straddling the moving average, and you have trapped bears and you get the sudden breakout. Today we've been above the moving average all day, and so it would be less, there are fewer trapped bears, so there's a less compelling reason for a big breakout. It looks like we're going to get the breakout, but I think we're going to have a hard time getting above this measured move target. And if we get there, I think we'll probably try to sell off back to the open of the day in the final hour and a half or so. Will we? I don't know, but that's what often happens when you go to a measured move up based upon the low to the open. Consecutive bull bars closing on their highs, a possible measuring gap, but I think bears will sell somewhere above. You know, we have this measured move target here. The gap above 15, or the 15 high, has been tested twice, so that makes that more reliable. And we have a double bottom here and here, a neckline here, so there's a potential measured move up here as well. However, this is still probably a bull leg and a trading range day. Reversal days often just rally up for the remainder of the day, so it can continue to go up for the rest of the day. But I think bulls right now are unwilling to buy high. They only want to buy pullbacks. Strong enough breakout, probably at least a little bit more up. Again, we have that measured move up from this gap. We got to within a tick, and that's close enough for the bulls to feel like they adequately tested it. We're running out of time. I thought we might go up to a measured move from the low to the open and then back down to the open, but I don't think we have enough time to do that, so that makes me think that either we go back down to the open from around here, we'll probably need a micro double top, or that we'll just keep working higher and close on the high. So I don't think we're going to get up here and then back down to the open. Can we go a lot higher here? I don't think we will. You can see the breakout is comparable to that day over here, and we went sideways for about 10 or 15 bars and then not much higher. And today is similar. You know, I think probably sellers above 60, buyers below 60, and will stall around here. The high of the day will probably be either right where we are or a little bit higher, and unlikely to become a measuring gap. So the bulls would like a measuring gap. Here's the low of the day, and here's the gap, and they'd like a measured move up, but there's just not enough momentum up for that, so the odds are it will not happen. Bear II closing on low. I think the always in bulls get out, even though we have 4 consecutive bull bars. Limit order bears sold the 51 high and 1 point higher, and they'll scale in higher above. And for the bulls, terrible follow through after the breakout. I would get out of longs here. And for the bears, they can only sell here if they're using a wide stop, maybe above this measured move target. Limit order bears selling 1 point above 51 can take profits. Some profit taking back down to the open. We'll probably close right around the open, so probably not much down. Since it's a trading range for 30 bars, 40 bars, you have to assume we're going to fall below the 45 low. However, probably buyers there. Trading range, you typically fall below support, reverse up, go above resistance, reverse down. Whenever you get these trading range days that test the open, once they're at the open, they decide on 3 things: continuing down to the low and creating a bear inside bar today, getting back up to the high, creating a bull bar, or staying around the open. And most of the time they stay around the open. Trading range day, tested the open, bounced at the end. Trading range day, tested the open, closed around the open. Tested the open here, tried to get up to the high, and came right back to the open. Trading range day, sold off, got back to the open, tried to go to a new high, came back to the open. Trading range day, tested the open, tried to reverse back up to the high, failed, broke to a new low of the day, failed, and came back to the open. Trading range day, worked its way back to the open, and then went back down to the low of the day. Trading range day, got back to the open, went above, below, above, tried to get down to the open, could not, reversed up and closed above the open. Tested the open, tried to sell off, they bought it, and we went higher. It continued the trend up that was going on here. Very good rally, tested the open, and we got a late rally. So if it's bullish most of the day, there's a higher chance of the day closing on its high. And if it's bearish most of the day, there's a higher chance of it closing on the low. But most of the time it closes right around the open. Today was slightly more bullish than bearish, so it's slightly more likely that we'll close up near the high. But most likely we'll close right around the open, maybe a little bit below, and get a bear body for the IOI. Remember, the market is way overbought on the daily chart and the weekly chart and the monthly chart. So there's a higher risk of a reversal. Okay, traders are selling at the market here. Who knows what's going on? But the bonds and currencies are moving as well, so there's some news taking place. I think this kind of a thing is important. The market is deciding whether it's making a significant top, and it's selling off selling off, and the bulls keep buying. And one of the times the bulls will not buy. There's a little bit of a parabolic wedge, bear bars, doji, bear bar, doji, and third bear bar. Will we get back to the open? I don't know. Would I sell above 69? I would not. Would I sell below 69? I would not. It's a trading range day. We broke below support. Remember, I've been saying all day, buyers below 16 and buyers below 45. Well, that's what happened. The bulls have bought the 16 low, made a 1-point scalp. Because it's a parabolic wedge and a very big bar, and the bulls made money buying below obvious support here and here. Well, they did not yet make money buying below here, but they certainly made money buying below here. It makes me think that we're probably going to close somewhere around the middle, but the sell-off is strong enough to make it likely that we'll close below the open. And actually, that's the high close. The open is right here. So, I don't know, maybe we'll close at the open. I don't know. I would do nothing here, probably buyers below and sellers above around the open. Whenever we have a big sell climax, its high is a target, but if we get up there, there'll be sellers up there. There's still always a small chance today could be a big bear day, but it's not likely. I've been saying since the open that it would probably be an inside day, and this has not done enough to make me think otherwise. What happens when we get back to the open? We're probably going to be in a trading range. So, we might get up to the top of the sell climax high. Will we get all the way up to the high of the day? Not likely. Probably sellers around the open and the sell climax high, and then a trading range for the remainder of the day. After 3 bull bars, bears are not going to sell below 71 or above any of these bars as well. They're looking to sell, but they want to sell near the sell climax high. And bulls, I don't know, I would not be buying closes. We're right at a logical target. The market's probably going to close right around the open. Because the sell-off is strong, I think it's going to close below the open, but probably not at the low of the day. So I think it'll be an IOI with a bear body. So sellers above, not great to sell with a bull bar after a parabolic wedge, but sellers somewhere around the open. Maybe if the bears are lucky, it'll get up to the 68 high. Limit order bulls who bought the 71 low. I often placed a buy limit order a tick or two below in a situation like this, because we may get down to these lows as well, and we may have a hard time getting 1 point above. Anyway, the bull scalpers did get out right here. I think it's more likely that we're going to close below the open, in part because the market is so overbought on all the other time frames, and because the sell-off is stronger than the rally. This is a surprisingly strong sell-off. Is there much risk selling here? Well, the only risk is time, right? You could run out of time. We start to go up, and then the day ends and the market's up here. I would not be buying up here. To me, the buy was the 71 low for a test back to the open. For the bears, a low too short, but 2-tick tail, 1-tick body, not a great sell. Probably sellers above 74 and sellers around the 68 high if we get up there, and probably close around the open. Well, I was hoping that we'd go up. I was going to try one more sell, but I'm not selling down here despite a low two. Too much of big down, big up. It reduces the chances that we're going to get very far down. Plus, we're getting pulled to that magnet at the open of the day. In the middle of a trading range day, you can see daily chart. But as I said, sometimes when you get these tests, in the final bars, you go one way or the other. Here, the final couple bars were broke to the upside. Here, a couple bars down. Two bars down right at the end of the day. Bulls want a measured move up, hoping there's a gap, 71 high, 74 low, but it overlaps by 2 ticks instead of 1 tick or no ticks, and that reduces the chances that the bulls will get a measured move up. Takes us to the high of the day. So probably sellers above and probably close around the open, and probably buyers below, but I still think it's slightly more likely that will close just below the open than above the open because of that sell-off. I'll buy a low 1, especially with 3 bull bars, but I'm not going to be buying a low 2, especially with a bear body. Well, it's too late in the day, but if it were not, I would be buying the 72 low or the 69 low. This is too late in the day for me to trade with limit orders. Well, not always. Sometimes I will, but I'm not doing it here because I think it's slightly more bearish than bullish, so it's slightly more likely if we're going to have a move to have a move down than a move up. It's always entertaining to see these things that appear minor and random play out, and they're not minor and they're not random. Weekly chart, while not likely, we could still trade upside down. We traded above last week's high. We have 3 days left to get below last week's low. So this week could be an upside down week. It's 49 weeks without touching the moving average. Never happened in the history of the E-mini, and therefore not likely to continue much longer. Monthly chart, 12 months without touching the E-mini. Only once in the past 50 years has the S&P done that, and that was 13 months back in 1995, and then it got a 4% pullback. So that was sort of a huge bull trend. And as strong as this is, it's nothing comparable to 1995 to 2000. And therefore, I think it's going to have a hard time getting much more overbought than 1995, and therefore probably going to pull back within the next month or 2 or 3. Daily chart, I showed that chart saying that this is the longest stretch in 90 years when the market has not had a 3% correction. The prior longest stretch was 241 days, and now we're 243 days. And obviously, we never have to have a 3% correction. We never have to have a 1% correction. However, markets do what they've done in the past, and therefore we will have a 3% correction, a 5%, a 10%, a 20%, a 50%, a 70% at some point. There's no, it's not going to happen. The 50% is not going to happen anytime soon, but we'll get another 50% correction. Who knows, sometime in the next 10 years or so. Anyway, we had a credible top. We have a buy climax and a wedge. A little wedge like that after a buy climax. Minor reversal, but because it's so climactic on this chart and the weekly and monthly chart, a minor reversal has a higher probability of actually becoming a major reversal. It triggered with the gap down here on Thursday, but we reversed up, and now we broke above, and now we're reversing down a second time. This was not a good sell signal bar, so outside down alone is not enough for a sell signal. But if today ends up with a bear body, especially if it closes on its low, then we'll have a bear IOI, and that would be a credible sell setup for tomorrow for consecutive tops. We tried to top here and failed, and then we would be trying to top a second time here. That would have a higher probability of starting some kind of a pullback, 10 bars, 2 legs. I think we're going to get back here. I still think we'll get here before the end of the year, the breakout point. And I think we'll get back here sometime in the next few months, because we only tested a couple ticks below this and rallied strongly. And usually when you have a big tail on the bottom of a bar and it only tests a little bit below the support level, it has to come back and test it again. So I think we have to test this at some point. It's about 100 points down, some point in the next few months. We knew today was going to be an inside day. The odds were very high that it was going to be an inside day. Yesterday was a very big bear trend day. 50% chance we would get some follow through selling in the first 2 hours. We did. With the market not gapping far below yesterday's low and selling off from the open, the bears missed an opportunity to have a panic sell on a huge bear trend day. Instead, bear channel, bull flag, and we got a breakout, not just a little bit, but a pretty big breakout above the bull flag, back into the middle third of yesterday's bear trend. That immediately made today likely to be an inside day. Yesterday was a very big day. That increases the chances that today's going to be an inside day. Today opened in the middle third of yesterday's range. That increases the chances that today will be an inside day. Yesterday tried several times to close a gap on the daily chart. It could not. Therefore, the bulls were very strong. If we get down to that area again, the bulls will be strong again. That increases the chances that the initial sell-off will fail to get below yesterday's low, and that today will be an inside day. I thought that even if we did trade below yesterday's low, we would not get much below, because whenever you have a big day like yesterday, and then today opens in the middle of yesterday, to get below yesterday's low, you're overlapping a lot of yesterday. And usually if you're overlapping a lot of yesterday, you do not end up with a big trend day. If you're going to get a big trend day, usually today has to open near yesterday's low, not this far up. So all of that said, the odds favored a early reversal up, and I thought we would not get above yesterday's high. That meant we'd be an inside day. First bar of the day, yesterday the first bar, the open of the day, remained the high of the day, only about once a year. Today we opened on the low after gapping above the 60-minute moving average and the bear channel, and only 20% chance that the open is going to remain at the low of the day. So 80% chance we're going to get below. Yesterday, 80% chance by the close of this bar that we were going to get above here at some point during the day. Did not. So this is one of those 20% days. Today was one of the 80% days. The bulls tried to rally from the open, and we quickly went back below the open. So a high 1, a high 2, with 3 bear bars, 2 of them being big, sellers above, but that warns us that we'll maybe might get a wedge bottom. It was unclear whether 7 would be the start of the wedge reversal, or if we'd get one more push down. It's possible that 2, 3 are strong enough so that the count started over again, so it's 1, pullback 2, pullback 3. But the odds were that either we would reverse up above 7, or we would trade down below 7 and then reverse up. And you can see we just went up really slowly. We got a little breakout, 17, and 18 I thought was a very important bar. The bears tried to create a failed breakout, a second leg trap, and they could not trigger it. They could not get below 18. And that meant we were probably going higher. And then 18 only overlapped 15 by 1 tick, and that meant this might be a negative gap, a 1 tick overlap, and that often leads to a measured move up. And look at the high of the day. Exactly a measured move from that gap. So we're probably going higher, but the rally was weak, and therefore there's probably a bull leg in a trading range day. When you get these reversal days, we sold off, we reversed up. Sometimes you can reverse up all day. But a lot of times when it gets to some kind of a measured move target, the market gets drawn back to the open of the day, which it did. I thought 45 was interesting. Normally, if you test a key price, we test the 15 high here and again here. That's usually it, right? If it falls below this price, it's usually going to fall at least far enough for a scalp. The bears tried to get here at 45 and could not. We reversed up again. However, the odds were that if we fell below 25, we would fall to the next support, the 16 low. But since today's a trading range day, we probably would close around the open, and there'd be bars below 45. Well, I thought we'd fall at least enough for a scalp, and then below 16. 60, failed breakout of the high of the day, a bear II. And then we got 3 bear bars, and the bears could not sell above 63. They could not sell above 64, and then they just sold at the market. So, that's what I typically do. When I see the 3 bear bars and I know we're going to the open, I try to place a limit order to sell above the high of the bar, and a lot of times I'll just sell at the market if I'm not filled. So I usually typically sell during the 4th or 5th bars if the limit order does not get filled, and I look for a scalp. And then here, parabolic wedge, 3 pushes down, 1, 2, 3, and a bull bar, a magnet open of the day. We fell below support 16 and reversed. I think we're going back to the open of the day. And 2 legs up, I thought we might get here, and I made a mistake in not simply selling the 74 close, but I'm always I always worry in the final 30 minutes, final hour, about using wide stops and scaling in. So I ended up not selling the 74 close. I tried to sell higher, did not go higher. Okay, so big up, big down, big confusion. Enough bars so the bears can get a lower high major trend reversal. And but we're probably going to go sideways more for another day or so, and then decide whether to resume up, second leg up, leg 1, pull back leg 2, or top out and begin correcting down. Here's the low of last week. I think if we get below that, that would give us maybe a 40% chance of the start of a swing down. Stop entries today. You could buy above 1 for the low of the day. I would not. The odds were 80% we were going below the 1 low. And then sell below 2. Well, there's room to the moving average, but I don't know that we're going a lot lower because we probably will not get below the low of yesterday. And then selling below 5, I think buyers below. Buying above 7 or 8, parabolic wedge, opening, reversal, possible low of the day. But enough confusion, enough bear bars. Probably we'll have to go sideways a little bit before we go up for about 7 bars, bar 13, possible lower high, maybe a little wedge, but probably buyers below. And then 16 tested below the buy signal bar high, the 7 high, which it often does, and it reversed up quickly. And 17, I thought made it clearly always in long, so we're probably going up for some kind of a measured move. Stop entries below 2, and then I would not sell below 5, and then above 7 or 8 is okay. Stop below 7, and if you get stopped out, you buy more on the reversal up. And although you could sell below 15, taking a chance that we go down, wedge 1, 2, 3, I would not. I thought it was more likely we were going to get back up to the close of bar 1. And then stop entry up here. Well, you can start buying for any reason, but the buys look terrible, so we're probably not going up that high. Buying above 18, buying above 26, a bull bar. Buying above 39, a little triangle or a high 2, micro double bottom. But you need the wide stop at a minimum below 25, and we get another buy here and another one here, 56. And then for the bears, selling below 2 is reasonable. Selling below 30, tight channel, probably just 2 legs sideways to down, and selling below 61. The bears have a better chance, higher probability to wait to see if we get 2 or 3 bear bars, 2 or 3 big bear bars, 3 or 4 smaller bear bars, and then sell closes or sell with limit orders. Selling below 67, I would not. And then in here, I think it's all limit order trading. Maybe buy above 69 for a test up to the 68 high. Buy the close, sell the close. Big outside down on 1. If you're quick, you can sell the close. 3 consecutive bear bars. You only sell that close if your stop is above 2. And then I would not sell the 6 close. If anything, you're going to buy a parabolic wedge. We're probably not going to fall below yesterday's low. So this is probably a sell vacuum test of yesterday's low, and we'll probably reverse up soon. 17 was the first, I thought, decent buy the close bar, maybe bar 9. And then none of this is really all that good. Buy the close, sell the close. For the bears, 62, 63, 64, 65, sell the close. And I would not sell the 68 close because I thought we would test back up to the open. In the final seconds, you can see they're paying attention to the open of the day because it affects the appearance of the daily chart. Will today have a bull or bear body on the daily chart? When the body is really small, it's just a couple ticks, I think it does not matter if it's a bull or bear body. Limit orders today, probably buyers below 1, but far above the moving average, so I would not buy the 1 low. I would only start buying a point or 2 below. And I thought it was interesting that the bulls made money buying the 5 low, scaling in. It was a 5-tick trap for the bears. Probably buyers below 12. Probably, but less likely, buyers below 15. And then up here, tight trading range, always in long, targets above. Probably buyers below everything. Bears made money selling, not over here, but they made money selling up here. I said I would not sell that high. I would sell 1 point higher because we may get a big gap, but if we get a gap, it should test back down to within 1 point. And then sellers above 66, buyers below 71, and then I ended up not taking any more trades over here. Okay, you can see bear body. We closed below the open, and therefore this is slightly more bearish than bullish. It's an IOI, but a bear body. Big tail on the bottom, so not good for the bears. I mean, not very good for the bears, but slightly better for the bears than for the bulls. Try to keep the questions short, because if they're long, I get confused and everybody gets bored and they have a hard time following my reading. Question about Tesla. I'll take a look at it. Assuming, okay. Again, the 5-minute Tesla chart, I sold bar 2 and get out after the close of bar 3. If you get in where I would you manage it differently? And would you sell at all during the first 30 minutes of the chart? I don't have any problem selling during the first 30 minutes of a chart, first 5 minutes of a chart. My only problem with selling bar 2 is it looks a lot like the daily chart. Well, it's not an outside down bar. It's a very, very big bear bar. And we opened a little bit above the low, and the S&P was likely to have an inside day and an opening reversal up, and therefore Tesla was probably not going to fall very far. So, when I trade stocks, I do pay attention to what's going on with the overall market. And today was likely to have the sell-off on the open today was likely to fail, and we were likely to reverse up. And if the overall market reverses up, that means most stocks are going up, and that means it's hard for other stocks to go down. So, but the question is, what would I have done? Would I have sold that close? Absolutely not. Yesterday's a sell climax. We know after sell climax day, 50% chance you'll get some follow through selling, but also 75% chance the day is going to enter a trading range by the end of the second hour, and sometimes right on the open. So I personally would not have sold the close of 2 right at support, yesterday's close, yesterday's low, and after a sell climax. So I would not have taken that sell. And you can see what happened. A lot of traders bought it. They saw it as a test of yesterday's close, yesterday's low, and they thought it was going to be a sell vacuum test. Remember, every day on the open, any market, if you see a strong move down or a strong move up, 50% chance it's going to reverse. So that means that if you're selling that 2 close, there's a 50% chance it's going to reverse either there or maybe one more bar. So that's not high enough probability for a scalp. And is it high enough probability for a swing? After yesterday being a sell climax, we're probably not going to go down all that far. So I'd like to see a break below yesterday's low with decent follow through, before selling low. Remember, trading range is likely at some point before too long. And in a trading range, I don't want to sell near the bottom of anything. I want to buy low and sell only high. The question, I'm having trouble seeing the breakout mode. I'm not sure the different things to look for. What are the main qualifications of this? Okay. Yeah, breakout mode. You can, Richard posted a video of that webinar that I did with Futures.io the other day on the Brooks Trading Course site, and I don't know if the admins on this site, the Brooks Price Action site, I don't know if they also posted it, but I talked a little bit about it. In general, the things that I look for when I think the market's in breakout mode. And so first of all, I pay attention to the time frame, right? So the range has to be appropriate for the time frame, and the range, I'm looking for a breakout and a measured move. And if the range is huge, it's unrealistic to think that I'm going to get a breakout and a measured move. It's more likely if I get a breakout, it's going to reverse. So I want the range, the tight range, to have enough room up or down for a measured move up or down. So in general, I want the range to be at least half of the size of yesterday's range, for example. And usually I want to see a double top and a double bottom within the range. And usually the market has to go at least 10 bars. And those are the 3 things that I look for. For example, this is breakout mode here. We know 25 is an important price. It's the second test of the breakout point, the 15 high. So if we break below 25, we're probably going to go lower. That's twice testing support, holding, and if it tests again and does not hold, the bulls will give up. So that's a breakout mode to the downside. And then we have a double top, we have a double bottom, double top, breakout mode to the upside. But late in a trading range day and a target above, I would not buy on a stop up here. This is an example of breakout mode, but the measured move up is beyond an obvious target, and we're in a tight trading range. So to me, this is a breakout that's more likely to fail than to succeed. A question about psychology. Why is it so powerful to believe that we always think the market is about to reverse and then we get run over by the trend? What can be done to prevent this? Well, I think it's natural to bet that the market will stay around an average, right? Because that's how averages exist. Average behavior exists most of the time, and extreme behavior would not be extreme if it was present all the time. That would be normal. And strong trends don't happen that often. Maybe a couple times a month, a few times a month, and that means that if every day you're betting on a strong trend, you're going to be wrong 90% of the time. You'll be right 10% of the time. And you just have to have rules in place to protect yourself. Excuse me. And, yesterday all day long, I kept looking for gaps, and it made me less willing to trust the trend. Here, everyone gave up. But through the first half of the day, I kept saying, yeah, it's a small pullback bear trend, but where are the gaps? Usually, in a small pullback bear trend, you get at least a couple gaps or at least one negative gap and one actually open gap. And it's very difficult for the bulls to make money. Yet the bulls are making money here for the first 40 bars. So that's unusual. But I also said that the channel down is very tight, and I would not be buying with stops, or if you buy with stops, you got to make quick decisions. The market never became always in long. And one of the things that I use, I talk about always in pretty regularly. If the market is in a bear trend, it's always in short. If there's a buy signal, you don't have to take the buy signal. You can wait to see if there's a strong reversal up and then buy. However, a lot of times the buy signals, bears will get out. Like they might get out above 12, they might get out above 18, they might get out above 27, right? Bull reversals, plausible setups for minor reversals. But if a trader is trading always in, that means he wants to be always in the market. And therefore, he wants to get back in quickly if he gets out. And he usually tries to get back in below a bear bar, like below 15, or if it looks like we might get a couple legs up, he'll wait for a low 2 and then sell, maybe below 24, or below a bear bar 25, maybe below 40, maybe below 24, excuse me. Maybe below 43 over here. But the point I'm making is, if I'm ever buying in a market that I think is always in long, and I expect the reversal is going to be minor, in other words, I'm looking for a scalp, I'm always going to get out where the always in bears will get back in. So if I buy above 12, I know the bears are going to short below 15. If they get out, they got to get back in. If I buy above 18, the bears will sell a low 2 or below a bear bar. So I'm going to get out below 24 or 25. If I buy anywhere in here, I'm going to get out below 36, a low 2 at the moving average with a bear body, or a low 4, 24. So that's one thing that I do. If I'm buying and the market's still always in short, and I think the bears might get out, or some of the bears will get out where I'm getting long, I get out where they're going to get short again, because if they're trading always in short, they're going to sell again below a bear bar. And a lot of times their entry will not look good, but if it's a bear bar closing below its midpoint, especially if it's like a low 2, I'm going to get out. I'm always going to get out, because I don't want to be buying for a scalp in a bear trend when a low 2 is triggering, because at that point the probability of me making money is low. If I'm scalping, I need high probability. So by definition, my trade is instantly bad. So I got to get out. But people are always hopeful, and they're always looking for good. So they're always looking for, the market's going too far this way. It's only fair that it should go the other way. And that's just human nature. And so it's natural to always be looking for reversals. But you have to have guidelines and ask yourself, is the reversal minor or major? If it's minor, then you need high probability. And if it's high probability and you get the market going against you, it's no longer high probability and you have to get out. And if it's a major reversal, then you can use wider stops, and you can accept the market going against you once, sometimes even twice, if you're very confident that the major reversal is good. But yesterday, all the buys were minor reversals. There were no major reversals yesterday. And therefore, if you buy, you have to get out pretty quickly, because the market's still always in short, and you're high, you now have a low probability bet, and scalping always requires high probability. But it's hard to see this stuff real time and to believe it's true real time. But if you trade enough and you get burnt enough, you'll start getting good at getting out where you think the bears have to get back in. So if you're buying in a bear trend, you can see where the bears are going to get back in. If they get out, you have to get out, unless the market has already converted to a bull trend. But if it has not clearly converted to a bull trend, you got to get out. Okay, hope everybody has a good night.